The global AI software industry brings productivity, automation, and cloud computing into a single, rapidly expanding digital infrastructure. Previous technology cycles focused on digitizing existing manual tasks, moving paper ledgers to spreadsheets or physical mail to digital inboxes. The current cycle aims at something more complex, automating cognitive work, performing analytical and generative tasks that previously required human thought. The promise of this capability has attracted billions of dollars in capital. Investors are rushing to fund systems that can write code, analyze legal contracts, and synthesize medical data. This influx raises a definitive financial question. Can the future cash flows generated by these cognitive tools ultimately justify the massive scale of investment happening today? The shift from basic digitization to cognitive automation changes the underlying economic survival rules for the software industry. Traditional software companies typically enjoy high gross margins because the cost to reproduce and distribute code to the next million users is virtually zero once the product is built. AI software breaks that economic model. Operating large language models requires substantial ongoing computing infrastructure. Constant data acquisition, model training, and continuous hardware upgrades introduce heavy expenses that drag down the bottom line. Facing labor shortages and productivity pressures, corporate management views AI spending as a strategic necessity. This creates high revenue visibility for AI vendors, but visibility is not the same as profitability. Imagine an AI software company generating $10 billion in annual revenue. If that company spends $4 billion on cloud infrastructure, $2 billion on research and development, and another $2 billion on sales and administration, the actual free cash flow is only a small fraction of the top-line number. High-growth revenue figures can effectively mask a cash-incinerating infrastructure. Investors must determine whether current spending is building a durable competitive moat or merely funding an expensive race for market share. During the early stages of a technology cycle, capital reliably floods into perceived winners. Elevated valuations allow these early leaders to raise funds easily, which they deploy into aggressive hiring, acquisitions, and infrastructure expansion. Historically, this leads to a predictable consequence. Supply eventually outpaces economically justified demand. Even as revenues climb, the return on invested capital declines because too much money is chasing the same opportunities. There are genuine strengths in the current market. Enterprise adoption is expanding across healthcare, legal workflows, and cybersecurity, yielding measurable productivity gains for the businesses deploying them. This chart reveals the broader monetization trap. High user adoption is financially meaningless if the customer refuses to pay enough to cover the underlying computational costs. Reported adoption metrics are an illusion if the core technology costs more to operate than the market is willing to bear. Looking at current balance sheets, many leading AI software firms maintain strong liquidity and relatively low debt. Yet those metrics can hide financial pressures from cash burn, stock-based compensation, and massive hardware commitments. Long-term margins are uncertain. If hardware costs decline rapidly, software margins will expand. But if vendors must constantly increase compute power just to stay competitive, the infrastructure providers will extract the majority of the profits. Market valuations price in perfection, assuming years of exceptional future cash flows that don't yet exist. Because of these expectations, a company can grow revenue, yet still suffer a severe stock collapse if it slightly misses assumptions. In the AI sector, economic survival is a race against the market's extreme financial expectations, a challenge that often outweighs the technical innovation itself. Consider a regulatory shock scenario. Governments suddenly enforce strict mandates covering model transparency, copyright compliance, and data usage limitations. The macroeconomic impact is immediate. Compliance costs spike, deployment cycles lengthen, and restrictions block certain high-value enterprise use cases. A sharp market divergence follows. Mega-cap tech firms with vast legal budgets absorb the new friction. Smaller competitors struggle under the disproportionate expense. Operating expenses rise, margins compress, and free cash flow weakens. Unable to afford the auditing burdens, smaller firms face forced consolidation. Regulation does not destroy the industry, but it transforms compliance into a competitive moat that starves smaller software firms of cash. The ultimate test for these companies is economic durability rather than technological hype. The positive indicators of resilience are clear: high recurring revenue, disciplined spending, strong customer retention, and undeniable productivity outcomes for the end user. Conversely, the warning signals are deteriorating gross margins, accelerating cash burn, and a widening gap between reported usage and actual revenue. In an optimistic future, AI delivers massive productivity improvements that vendors convert into durable, expanding cash flows, justifying today's infrastructure build-out. In the downside scenario, widespread adoption meets weak monetization. Revenue stalls while infrastructure costs remain elevated, triggering a structural collapse in valuations. The industry's success depends on whether sustainable free cash flow and economic profitability emerge at the scale current valuations demand. The AI software sector is a real-time economic stress test. The market will eventually separate the companies building true businesses from those merely burning capital.